Anthropic has raised somewhere north of $7 billion, and by most estimates, they're still losing money on a significant portion of the AI requests they serve. That is not an accident. That is the strategy. And once you understand why, you'll see the entire AI industry differently. Here's the full breakdown of one of the most fascinating, and frankly brutal, economic models in modern tech. Let's set the scene quickly, because context matters here. Anthropic was founded in 2021 by Dario Amodei, Daniela Amodei, and a group of researchers who previously worked at OpenAI. They left over disagreements about the pace and safety of AI development. So from day one, Anthropic positioned itself differently, not just as an AI lab, but as a safety-focused AI lab. That distinction sounds like marketing, but it actually shapes everything about how they spend money, how they fundraise, and who they partner with. Their flagship product is Claude, a large language model that competes directly with GPT-4, Gemini, and a handful of other frontier models. Claude is available via API for developers, and through Claude.ai for consumers. As of mid-2024, they reportedly had somewhere around 1 million paying users and a growing enterprise customer base. But here's the part that gets interesting, and that most coverage glosses over: the revenue Anthropic generates doesn't come close to covering what they spend. At least not yet. And the gap between those two numbers is enormous. To understand Anthropic's economics, you need to understand one thing: running a frontier AI model is extraordinarily expensive, and most people have no idea how expensive. There are two major cost buckets. First, training. Training a model like Claude 3 Opus, their most capable model, reportedly costs somewhere in the range of tens of millions of dollars for a single training run. Some estimates for comparable frontier models push past $100 million when you factor in failed experiments, data preparation, and the engineering hours involved. You don't do that once. You iterate. You retrain. You fine-tune. Each generation of Claude requires a new round of compute, and compute isn't cheap. Anthropic runs much of this on Google Cloud infrastructure, which is part of why Google has poured billions into the company. It's a customer relationship as much as it is an investment. Second cost bucket, inference. This is the cost of actually serving Claude to users in real time. Every message you send to Claude, every API call a developer makes, requires GPU cycles to process. At scale, that adds up fast. There are analyses floating around, and some insiders have suggested that for certain model tiers and use cases, the compute cost per query can actually exceed what the user paid. Meaning Anthropic serves the request and comes out behind. That sounds insane. But it's a documented pattern across multiple AI companies right now, and it's completely intentional. So how does a company survive burning money at this scale? The answer is, they've become extraordinarily good at raising it. And the investor list here is genuinely unusual. Google has invested around $300 million initially, followed by a commitment reportedly totaling around $2 billion in exchange for Anthropic using Google Cloud. Amazon made an even larger move, committing up to $4 billion in Anthropic, with a portion settled and the rest conditional. Amazon also gets Anthropic workloads running on AWS and access to custom chips called Trainium and Inferentia. Then there's a 1,600% different kind of backing, from funds like Spark Capital, from sovereign wealth sources, from strategic angels. In total, Anthropic has raised over $7 billion across multiple rounds. But here's the part nobody mentions: a huge chunk of that funding is tied to cloud credit agreements. Google's money partly comes back to Google as Anthropic pays for compute. Amazon's investment follows a similar logic. So the headline. Funding number is real, but it's partially circular. The money flows in, then flows right back out to the infrastructure providers who put it in. It's an ecosystem, not just a fundraise. What this means is Anthropic's actual cash runway looks different from what a $7 billion number implies. They're on a treadmill, a very expensive, very fast treadmill, and the goal is to scale revenue before the runway ends. Now let's talk about the revenue side, because it's more interesting than it looks. Anthropic has three main revenue streams. First, the API. Developers pay per token, meaning per chunk of text processed. Claude's pricing is tiered by model. Claude Haiku, the lightweight model, is cheap, fractions of a cent per thousand tokens. Claude Sonnet sits in the middle. Claude Opus, the big one, costs significantly more. This per-token model means revenue scales with usage, which is good. But so do costs, which is the problem. The margin on inference is thin, and depending on usage patterns, it can go negative. Second stream, Claude Pro and the consumer subscription tier. At $20 a month, this is the direct consumer play. Compete with ChatGPT Plus, grab the individual knowledge worker who wants a premium assistant. This is a higher margin play than raw API access, assuming users don't max out their usage. And most don't. Third, and this is where the real money is starting to flow, enterprise. Anthropic has been quietly building out enterprise agreements with large companies that want to run Claude on private infrastructure, with custom fine-tuning, compliance support, and SLAs. These contracts can be worth millions per year. Companies in finance, healthcare, and legal tech are reportedly among the early adopters. Enterprise is lower volume but dramatically higher margin, and it doesn't have the same compute cost problem because clients often do more of the infrastructure heavy lifting themselves. The shift toward enterprise is the clearest signal that Anthropic knows exactly where their sustainable economics live. Here's the open loop I want to close, because this is the part that makes the whole thing click. Anthropic's economics look irrational if you evaluate them like a normal software company. You'd look at the burn rate, the thin margins on inference, the circular funding, and you'd say, this doesn't work. But that framing misses the actual thesis. The bet Anthropic is making, and the bet their investors are making alongside them, is that we are still in the land grab phase of AI. Right now, every major foundation model lab is prioritizing capability and adoption over profitability. The logic is that whoever builds the most capable, most trusted model, and gets it embedded deepest into enterprise workflows, will have an almost impossible to displace position in 5 years. Think about how AWS worked. Amazon ran AWS at minimal margins for years, investing aggressively in infrastructure and developer relationships. By the time profitability became the focus, AWS had market position that nobody could replicate. Anthropic is running a version of that playbook, except the product isn't cloud compute, it's intelligence itself. And there's a second layer to this bet that's even more important. Anthropic's safety positioning isn't just ethics. It's a moat. Regulated industries, healthcare, finance, government, have compliance requirements that make them slow to adopt AI. But when they do adopt, they want a partner they trust. Anthropic's entire brand is built around responsible, interpretable, safety-conscious AI. That positioning, when enterprise contracts in regulated sectors start flowing in significant volume, could be worth billions in sticky, high-margin revenue. Analysts and industry watchers have floated a range of projections, and while the specifics vary, the general shape is consistent. Anthropic reportedly generated somewhere around $100 to $200 million in annualized revenue heading into 2024. That sounds solid until you put it against an estimated burn rate that some sources have pegged at several $100 million per year, potentially more when R&D and training costs are included. The path to profitability, or at least to sustainable unit economics, runs through 3 things. First, inference efficiency. Every generation of model gets cheaper to run. Claude 3 Haiku cost a fraction of what Claude 2 cost to serve per query. As efficiency compounds, those negative margins on inference start improving. Second, enterprise contract volume. If Anthropic lands a few dozen major enterprise clients at multi-million-dollar annual contracts, the revenue mix shifts dramatically toward high-margin work. Third, model commoditization at the bottom, specialization at the top. As cheap, capable models become widely available, Anthropic can seed the low-end API market and double down on premium, specialized, safety-certified use cases where they command pricing power. None of this is guaranteed. OpenAI has more distribution. Google has more infrastructure. Meta is open-sourcing models aggressively, which creates pricing pressure across the board. The window for Anthropic to find sustainable economics is real, but it is not infinite. Here's the thing about studying a company like Anthropic: the lessons aren't really about AI. They're about how to think about economics in a winner-take-most market during a technological inflection point. Spend aggressively to build capability. Accept negative margins in the short term to win distribution. Build trust as a durable moat. Use strategic partnerships to extend runway without giving up control. And keep your eye on the 1 or 2 revenue channels that will eventually carry the whole thing. Most people watching this space are focused on the products, which model is smarter, which app is cooler. But the underlying economics are what determine who's still standing in 5 years. And right now, the most interesting chess match in tech isn't the one happening in the models. It's the one happening in the spreadsheets. If that kind of analysis is what you're here for, the real mechanics, not the headlines, hitting subscribe is the single best decision you'll make today. We do this every week.